The economic slowdown continues. No, I didn't say the stock market. That's a whole different story. Some areas of the economy are good. We still have people going to restaurants. People are shopping for the most part. Cars are moving about on the roads. But of course, we can't deny that we have done all of this magnificence on borrowed time. Unbelievable debt that will collapse under its own weight. Hang on tight. You came here for the truth, so let me unveil that for you. Today we're going to look at the global economic slowdown. I want to give you all the details today of what's been happening, but first I wanted to start with a little humor. There's no way we're headed for recession. 5 experts, quote, experts, on the bond market's warning sign. I have done a few videos recently about the yield curve. I won't get into it too much today, but essentially these so-called experts have suggested there is no way that we're going into a recession. If you look through this article, it's very typical of mainstream financial news. What we are seeing here are individuals who have their entire career focused around these stock markets continuously increasing. There can never be a bear market because their job is on the line. They keep pointing to these economic indicators that are absolutely manipulated. We are looking at the VIX index. We're looking at the unemployment rate. We're talking about the jobs numbers. I mean, it's been understood for so long about the truth in these numbers, and yet most people either haven't picked up on it at all or they are willfully ignorant. Well, I know that you came here for the truth, so we're going to get into that today. U.S. consumer confidence weakens in March. Apparently, the American consumer is feeling less confident, everything that's been happening within the markets, with the economy in general, and so this number falls down a bit. But that can reverse very, very quickly. This is a number that, quite frankly, I do not put much weight on at all. It always changes, and even in the worst of times, sometimes you get these anomalies that don't really make sense. But I wanted to bring it to you because this is the type of data that they're ignoring, and yet this is a very mainstream type of indicator that should be present right now. Out of Reuters, U.S. housing and consumer confidence data point to a slowing economy. U.S. home building fell more than expected in February as construction of single-family homes dropped to a near 2-year low. The second paragraph talks about consumer confidence dropping, households are pessimistic about the labor market, less stimulus, Brexit, and the usual. Number one is the fact that interest rates have come down, and this has directly affected what we are seeing in the real estate market. I showed you how the mortgage rates had dropped after the Fed suggested that's it for their tightening cycle. The 30-year fixed mortgage rate dropped to an average of 4.28% last week, the lowest in more than a year, from 4.31% in the prior week. So there has been some fluctuation in the mortgage rates despite the fact that we have seen interest rates from the Federal Reserve moving in a downward direction in general. In this third paragraph, it's interesting because they suggest now it's become more affordable for individuals to get into the market, so that should offer some improvement, more sales, and so on. But people shouldn't be pushing it to the max. If your interest rate came down 0.5 percentage point, that shouldn't entice you to go in and buy a new house. It's really crazy to see how people push themselves to the edge, maximum debt from everything, mortgages, credit cards, and so on. This is not a good sign for the future. This is ultimately going to end very badly. You cannot do this. It's not sustainable. And yet here we are. The markets love it when they're spending. It doesn't matter if it's all on debt. Here's a chart that corresponds to that data, just trying to show you the housing starts. You can see that this had been doing better for years and years and years, but it seems to have peaked out around 2017 or so and has been declining ever since. I have found it very typical that after there is a Fed meeting, a Fed conference, one of the big boys talking in front of a big crowd, then they have to come out with other individuals in the Federal Reserve, get them into a few interviews with CNBC, with Bloomberg, one of the mainstream outlets, and have to clear the way of any negativity. Fed's Charles Evans says the US economy is slowing, but downplays a recession. So they can't go against what Powell said, but they can certainly make sure the markets stay calm. There are always this forward guidance, as they like to call it, meaning that they will instruct to the markets who are paying attention, the algorithms, using particular words in their sentences to ensure that this stays status quo. But then there was something so strange, and it's in the bottom paragraph, but essentially after the yield curve began to invert and the market started to pay attention to that, he said it's understandable that stock markets are a little bit nervous about the flattening yield curve. I think anytime, check this out though, this is strange. I think anytime the economy decelerates from 3.1% down to 2%, it takes a really sharp-minded focus to kind of go, all right, it's less than what we had, but it's still pretty good. What exactly is he trying to convey with that message? I just wanted to give you an idea of the 10-year minus the 3-month treasury to show you how this has in fact inverted. According to the Fed's website, it looks like it's just below. It's negative 0.03 right now. And you can see right here in the bottom right hand corner how it has fallen somewhat, but it's not that dramatic. We need it to remain down here for a period of time before it comes back up. If it's just happening for a day or two, this isn't really a good signal, but as we have seen, there have been many of these different yield curve inversions that taken place. I've seen somewhere around 40% the last time I checked. Others say more like 30%. I have to see the numbers for myself, but this really tells me that it's not just one, it's not just the 10 and the 3. We have to look at all of them and see that more and more and more as time goes on will in fact invert, and that just becomes more of a signal. Apple received some bad news today, and we'll see how that impacts the company in the longer term. Just wanted to show you that it has fallen below the 200-day moving average. It seems to remain there. We'll see the longer term impact, how it affects the stock, and so on. It's not just the housing market that has slowed a little bit here, not just consumer confidence, but US auto sales are falling as vehicle prices climb. That is a bad situation to be in, indicating that buyers at the lower end are getting squeezed out of the new car market. They mention all the numbers in here, talking about the sales expecting to drop and so on. I just wanted to bring you the fact that we are seeing this slowdown that's been dragging on, and yet the stock market doesn't seem to be affected by what's happening in the real economy. And we know specifically, for those who have been paying attention, central banks are behind all of this. They have decided that destroying the currencies is the name of the game, and they're going ahead with that. All the central banks around the world have been reducing their quantitative tightening policies. They flipped 180. They are starting to print more and more. Look at the ECB announcing another round of quantitative easing. The Fed has completely confused everybody at this point who is paying attention to them for advice. This is not a good thing that has occurred in the stock markets, and yet if people would look at the real factors, we would make a lot more sense of the things that are happening. Now, very quickly wanted to touch on China. Foreigners dumped the most Chinese shares on record via stock trading connects as they steered away from risk, and the country's benchmark index fell below a key level. Overseas investors net sold $1.6 billion worth of mainland shares on Monday. It's the biggest single day sale since the second exchange link with Hong Kong opened in December of 2016. What I've been noting over the last few months is that investors are tending to sell off their growth stocks and they're moving into more of these what they believe are stable companies, long-term, not worried about growth so much. The sentiment has ultimately changed. So I'm just going to show you the chart that's with that. Foreign traders sold most Chinese stocks since 2016. That's the chart. That's all I wanted to cover. If you found this video informative, please give me a thumbs up. When you give me a like on this video, you are supporting this channel, so I do appreciate that very much. If you want the financial education that you weren't taught in school, these two books have everything that you need, from the foundation, the history, the asset classes, making money, so much more. Check them out at the link if you want the audiobook that's available at themoneygps.com. This video is still going crazy. 5,600 stores in the United States are closing down. You need to watch this to really understand the magnitude of what's happening today. Click on it and I will see you there.